Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Okay, let's unpack this. If you're following the financial headlines, especially around mergers and acquisitions, M&A, the stories can feel, a little like science fiction.
Oh, completely. You hear about these $88 billion mergers.
Right, or companies just snapping up AI infrastructure left and right, and private equity funds deploying, $500 billion?
Exactly. And it feels like a world that's totally separate from the reality of, say, running a regional service business or a family-owned manufacturing company.
Yeah, and that's why we're doing this deep dive. We've synthesized the latest analysis from some of the biggest names, Deloitte, PwC, EY, BDO. But the mission today is specifically for you, the owner, the operator, the person who actually built a business from the ground up and is now, maybe thinking about an exit in the next couple of years.
We want to cut through all that high-level noise, look past the mega deals,
and figure out what these market signals really mean for realizing the value you've built. The core question is, are the titans finally making room for the middle market to cash out on, favorable terms?
And the central finding, really the anchor for this whole conversation, is that 2026 is shaping up to be defined by a tale of two M&A markets.
A tale of two markets. Tell us more about that duality.
Well, if you look back at 2025, it was all about staggering deal value. We're talking record-breaking numbers that we'll get into.
Okay.
But the deal volume, the actual number of transactions, it was pretty flat. All the enthusiasm and capital was just hyper-concentrated at the very top.
So the big guys got bigger.
Exactly. But what's so fascinating now is this sudden, sharp surge in optimism among deal makers for 2026.
And that optimism suggests what?
It suggests that the capital that inflated that top tier is now looking for a new place to go. It's looking to flow downstream directly into the middle market.
Right where our listener operates.
Right. So we really need to look beneath the surface of those billion-dollar headlines. That's where the real tactical opportunities are for the domestic seller.
So let's start by just establishing the scale of that top-tier market. Just how dominant were these mega deals in 2025? It's important to understand the high watermark we're talking about.
The numbers are pretty startling. According to PwC's analysis, the U.S. aggregate deal value hit an astounding $1.6 trillion through November 30th of 2025.
$1.6 trillion. That's a huge number.
It's a massive number. And it's not just bigger. It represents a 45% increase from the prior year. It's actually the second highest annual total ever recorded.
Wow.
And it wasn't some slow, steady climb either.
Yeah.
The year was defined by these really dramatic, sudden spikes in activity.
Right. I saw Deloitte highlighted that concentration. They pointed to the third quarter of 2025, where deal value hit something like $598 billion globally for U.S. targets.
That's right. That one single quarter was a 4-year high. Is a 56% jump just from the second quarter.
A 56% jump in one quarter.
And EY's analysis zooms in even more just on the month of October 2025. They found that total deal value soared an incredible 146.5% year over year.
That's just wild. What's driving that kind of a spike?
It's what you could call a whale hunting strategy. It defined 2025. Deloitte noted that the Q3 spike was heavily fueled by just 4 transactions.
Only 4.
4 transactions, each one greater than $10 billion. And that includes one spectacular $88 billion merger that was announced in July.
So a handful of massive deals are skewing the entire picture.
They absolutely are. October itself saw a huge uptick in transactions over $1 billion. Deal value in that segment alone climbed 203% year over year. So basically, if your company wasn't worth at least $1 billion, you weren't really part of the big story of 2025.
That concentration of value makes a lot of sense. So what was propelling this incredible surge at the top? I think I know the answer, but the sources point to 2 big interwoven drivers.
They do. It's the transformative potential of artificial intelligence and, of course, the immense financial muscle of private equity firms.
Let's talk about the AI piece first, the AI multiplier.
The AI multiplier is what really allowed valuations to break the mold. PwC tracked 74 mega deals in 2025. Those are deals valued at $5 billion or more.
Okay.
And a staggering 20% of them had a fundamental overt AI theme. And this isn't just, software companies buying other software companies. This is about AI's power to completely reshape business models in every single sector.
PwC used the term outsized multiples. When you say that, what does it actually mean? Is it just hype, or is there a real financial rationale behind it?
Oh, there's a strong rationale, even if the prices seem steep.
Yeah.
Buyers are paying those outsized multiples because of what they see as future revenue predictability and the potential for network effects.
So they're buying the future, not the present.
100%. A company that owns foundational AI tech or the infrastructure that supports it is seen as having a near monopoly on future growth. So if a big corporate buyer or a PE fund looks at a company and sees that its AI integration can cut operational costs by 30%.
Or open up a new $500 million revenue stream in a few years.
Exactly. They will pay a massive premium for that now. They are not buying 2025 revenue. They're buying 2030 potential. And that just drives the multiple far, far above historical norms.
It's the classic infrastructure play. If you're buying a data center operator or a microchip manufacturer, you're buying the literal foundation for the AI future. And you have to pay up to secure that spot right now.
That's it, exactly.
Right.
And the second major driver is what you could call the private equity dry powder factor.
Right. We mentioned this, all that money just sitting on the sideline.
PE funds are sitting on committed capital dry powder
Right.
that they are contractually obligated to deploy. They can't just sit on it forever. And after holding back during the high-interest, high-volatility period of early 2025, they just opened the floodgates.
And the numbers show that.
They do. PwC notes that financial buyer value vaulted 54% to $536 billion through November 30th. PE funds were massive contributors to that $1.6 trillion figure.
Okay, so we have record value, record PE capital, huge AI-driven premiums. Why are we still calling this a tale of two markets? Why wasn't 2025 a massive year for everybody?
Because of the crucial piece of the puzzle. Volume stagnation.
The number of deals.
Yes. The value figures are really misleading if you don't look at the number of transactions. PwC's data shows that while overall deal value was up 45%, the overall deal volume, the sheer number of deals closed, was only up about 2%.
Just 2%.
Basically flat. Muted. Corporate buyer volume was also only up 2%. This is the critical indicator. The high-level enthusiasm, all that capital, it just hasn't trickled down. Not uniformly, anyway. The big deals soaked up all the value and all the attention, leaving the domestic middle market seller just sort of waiting for their turn.
Which brings us squarely to our listeners' world, the domestic middle market. So if the mega deal market was, soaring into the stratosphere, what was actually happening in that crucial space, say the $100 million to $1 billion deal range?
The sources paint a picture that is, frankly, underwhelming for 2025.
Underwhelming is the word PwC used, right?
It's the precise word. Middle market activity was projected to hit its lowest number in a decade. We're talking an annualized 496 deals through November 30th.
The lowest in a decade. That's a massive slowdown.
It is, especially because the middle market is historically the engine of overall deal volume and activity.
So why the specific lull in that critical mid-tier? Why did Main Street feel this distinct pinch while the giants were all merging?
Well, the answer really lies in the fundamental difference between a mega deal and a middle market deal. Mega deals are often strategic. They're driven by an existential technological need. You must buy AI infrastructure to survive.
Right.
The middle market, on the other hand, is far more dependent on granular fundamental economics, day-to-day predictability. And PwC points out that this market struggled severely with macro factors like policy uncertainty from tariffs and, crucially, stricter immigration enforcement.
Okay, let's connect those dots. How does something like stricter immigration enforcement, which sounds like a political issue, translate into a hard financial constraint for M&A?
Because it creates massive uncertainty in your labor supply and your pricing. So if you're a regional manufacturer or, say, an agricultural processor, even minor volatility in labor availability or a sudden jump in labor costs from a policy shift can significantly destabilize your operating margins.
And that makes it hard to predict the future.
Incredibly difficult. It made it tough for these mid-sized firms to confidently chart a path to higher revenues and robust margins. And when your forecasts are shaky, it instantly widens that valuation gap between a buyer who sees risk and a seller who sees historical potential.
And this is exactly the problem so many owner-operators face, isn't it? They run these great traditional Main Street businesses, but they rely so heavily on stability.
They do.
Yeah.
And they often don't have the scale or the deep HR teams or the legal resources to just absorb tariff shocks or navigate these sudden policy shifts like a huge corporation can. They suffer from what we often call in M&A unclean financials.
Let's talk about that. That's a critical point for our listeners. The Main Street business often lacks institutional depth. What does that mean in practice?
In practice, it means the standard operating procedures, the SOPs, are often just locked in the owner's head. They're not documented. The accounting might be optimized for minimizing taxes, not for going through due diligence.
Which makes the books look messy.
Exactly. Messy or just difficult to audit for an institutional buyer, like a PE fund. And that operational risk is what kept PE playing mostly in the large deal space for much of 2025.
But you said earlier that this exact dichotomy, the middle market's lull, is where the 2026 opportunity lies. So how do we square that circle?
Because the market needs deal volume.
Mm-hmm.
And those PE funds are under immense pressure to deploy that dry powder we talked about.
They have to put the money to work.
They have to. And Deloitte explicitly identified this potential two-market phenomenon where small and medium deals must step up to offer significant value realization opportunities just to complement the spike in larger deals. The buyers are realizing they can't afford to just wait around for pristine A-level assets anymore.
So the private equity pivot down market is inevitable.
It's already happening. EY noted that while PE dominated the mega deals in September, their share of deals above $100 million actually fell slightly in October. And that's a really important strategic indicator.
What does it indicate?
It suggests they're actively pivoting toward mid-market and smaller transactions. Why? Because the competition for those perfect, already optimized A-level assets is driving prices beyond any reasonable return. So PE funds recognize they can get better returns by going down market and finding the diamonds in the rough.
The quality businesses that just need to be institutionalized.
Precisely.
That sounds like a lot of work for a sophisticated financial buyer, though.
Right.
I mean, if the financials are unclean and the SOPs are in someone's head, why would a PE firm want to take on that headache?
And this is where the small fund challenge and the concept of the operating partner become absolutely vital for you, the listener. PwC notes that smaller PE funds especially have to differentiate themselves.
How do they do that?
Well, they can focus on niche sectors, but their primary differentiation will be bringing in highly specialized operating partners to strengthen operations after they buy the company.
Let's elaborate on this operating partner model, because this sounds like the key to unlocking value for that owner-operator.
It absolutely is. The operating partner isn't just a consultant. They are often former CEOs or COOs with deep, specific industry expertise. They are brought in by the buyer to specifically fix those Main Street challenges.
So if your business lacks documented processes or audit-ready financials,
the operating partner comes in, cleans up the back office, documents all the SOPs, standardizes the technology, and ultimately institutionalizes the company. It turns the acquisition into a value creation project. The buyer is essentially saying, we see huge potential here, but we're paying today's price, knowing we have to spend the next 18 months cleaning things up, and we have the dedicated staff to do it.
That's fantastic news for the owner, who maybe hasn't invested heavily in corporate infrastructure but has a great underlying business. It means that lack of institutional maturity isn't a deal breaker anymore.
It's not a deal breaker. It's a potential value-add project for the buyer.
And that operational fix helps narrow the valuation gap we talked about.
It does. And since sellers are recalibrating their price expectations, buyers are responding with more creative deal structures. BDO highlights that deal makers are actively exploring earnouts and what they call multiples on invested capital, or MOIC earnouts.
These sound tailor-made for the owner-operator scenario.
They really are.
So explain the power of an earnout for that owner whose business is great, but whose 2025 books might be a little messy because of policy uncertainty or maybe a big capital expenditure.
An earnout is the ultimate bridge for that valuation gap. It's a contractual arrangement where a big chunk of the purchase price is contingent on the future performance of the company over, say, 2 to 3 years.
So instead of demanding a huge upfront price based on shaky 2025 numbers, the seller agrees to a lower guaranteed price now. But if the company hits some aggressive target, say $10 million in EBITDA in 2028, they get a bonus payment of $5 million.
That is exactly the mechanism. It incentivizes the seller, who often stays on for a transition period, and allows the buyer to mitigate the risk while they do that operational cleanup. It's a show-me deal. And crucially, BDO notes that these MLIC earnouts are particularly popular with PE.
Okay, so what's the difference between a standard earnout and a MOIC earnout?
A standard earnout is usually tied to something like revenue or EBITDA. A MOIC earnout focuses not just on the company's profit, but on the return generated for the financial sponsor itself.
So it's about their return on investment.
Right. A PE firm might invest $20 million, and they'll structure a MOIC earnout that says the seller gets X bonus payment if, upon our final exit, this original investment generates a 2.5x MOIC.
I see. So it aligns the seller's focus perfectly with the PE firm's ultimate goal.
Perfectly. It gets them focused not just on short-term profits, but on maximizing the long-term institutional value of the company, which, at the end of the day, benefits everyone involved.
So we've established the market has the capital. It has the structural tools like operating partners and earnouts to go after the middle market. Now, let's talk about the engine that's fueling all this confidence. That definitive shift from policy volatility to, well, clarity. That seems to be pushing the 2026 M&A optimism.
The rise in optimism is staggering. It really warrants attention. According to Deloitte's M&A Trend Survey, 90% of private equity respondents
90%.
and 80% of corporate respondents expect an increase in the number of deals they'll transact in 2026. This isn't just, a slight majority. It's a commanding consensus across the entire financial sector. They are betting heavily on a resurgence.
But hold on a second. We just detailed the volatility of 2025, the difficulty of that policy uncertainty, the dramatic deal concentration. How can we trust that 90% optimism? Isn't this just wishful thinking by deal makers who are, frankly, desperate to deploy all their dry powder?
That's a critical question, and the answer really lies in the specific macro shifts that happened late in 2025. They provided tangible clarity that was just absent earlier in the year.
And it wasn't just financial markers?
No, it was a major policy resolution. BDO points directly to the enactment of the One Big Beautiful Bill Act, or OBBBA, which was signed on July 4th, 2025.
Okay, let's just clarify the nature of the OBBA. Not politically, but purely its economic effect.
Sure, the OBBBA was this major appropriations and tax reform package that had been hanging over the market, just creating uncertainty. Its passage, along with some real progress on new trade deals, fostered a much more predictable business and tax environment.
So before OBBA, everyone was kind of in a holding pattern.
Exactly. Business leaders and deal makers were operating with this massive question mark over domestic policy. Once that legislation was signed, it lifted that shadow. It allowed executives to finally commit capital to big investments and strategic M&A that they had put on hold. Predictability is the lifeblood of deal-making.
So stability trumped whatever the ideology was. Once the rules were set, businesses could finally plan effectively.
That's it. And the second major clarity signal was interest rate relief, which directly hits the cost of capital. The U.S. Federal Reserve announced 2 strategic 25 basis point cuts in September and October of 2025.
2 cuts within a month of each other. That's pretty significant movement.
It is. And both Deloitte and EY highlighted this. Lower financing costs improve the arithmetic for buyers, especially PE firms that rely so heavily on leveraged buyouts. When the cost of borrowing drops, the internal rate of return, the IRR, on a potential deal improves significantly.
It makes deals that were maybe marginal before look much more attractive.
Absolutely. Deloitte called any further cuts a welcome tailwind for deal activity.
So we have policy stability, we have cheaper money flowing into the system. It sounds like a green light, yet you mentioned the confidence is still measured. Where's the caution coming from?
The caution is rooted in the lessons of 2025 and the persistence of certain macroeconomic headwinds. Deloitte's survey data captures this perfectly.
How so?
Well, while 80 to 90% expect volume to increase, the number expecting volume to increase significantly actually fell 16 points compared to the 2024 survey.
Oh, that's interesting.
It is. Most deal makers, now about 67%, expect volume to increase somewhat.
That reduction in significant optimism is telling. It suggests buyers are still going to be pretty picky.
It underscores the need for selective, disciplined deal making. Buyers are not going to just chase deals blindly. They're applying the hard-won discipline they learned during the volatility of the last couple of years. And that measured approach is necessary because the macro signals are not uniformly positive.
Okay, so what are the lingering risks that mandate this vigilance, especially for the smaller firms that are just less resilient to shocks?
The environment is still mixed. Deloitte notes some persistent headwinds, including a steady rise in inflation in recent months, an increase in unemployment figures, and continued tariff uncertainty that wasn't completely resolved by the OBBBA.
The classic margin squeezers for the middle market.
Exactly. If inflation stays elevated, your operational costs, raw materials, utilities, labor, they all keep rising. And that directly compresses the margins of a small business and just complicates the valuation.
And BDO was very clear that the most critical variable, the real risk to this whole forecast, is geopolitical stability.
Absolutely. Geopolitical stability is the uncontrollable wild card. BDO makes it clear that any extended conflict or escalation, particularly with U.S.-China dynamics, could instantly trigger renewed supply chain disruptions and severely deter investment.
And the impact would be swift.
Swift and severe across all transaction sizes. For a small business contemplating a 2026 exit, the geopolitical environment is the external factor that really dictates how long their optimal sale window is going to stay open.
Let's pivot now to the tangible elements an owner-operator can actually control. Because this policy discussion is no longer abstract, right? It directly benefits sellers who are preparing for a transaction. The OBBBA wasn't just about reducing uncertainty. It directly created a more favorable setting to make your business an attractive, cash-generative target.
That is the core takeaway. BDO notes that while no single provision in the OBBBA caused a massive surge, several clauses significantly strengthen a business's performance and financial attractiveness.
Specifically by boosting cash flow.
Right. The restoration of key incentives that boost cash flow immediately. So the restoration of 100% bonus depreciation and the full immediate expensing of domestic research costs, these are huge cash flow injections for capital-intensive businesses.
Let's make that 100% bonus depreciation tangible for the listener. Why does this policy move the needle so dramatically, especially for, say, a regional manufacturing firm or a mid-sized logistics company?
It's all about the timing of your cash flow. Under previous rules, a company would have to depreciate the cost of a new asset. Let's say $1 million piece of machinery over its useful life, maybe 7 years.
So they'd only write off about $140,000 a year.
Right. The restoration of 100% bonus depreciation allows that company to immediately write off the entire $1 million cost in the year they buy it.
That is an immediate, massive tax shield.
It's huge. It defers your tax payment, which massively boosts your current cash flow. And for industries like manufacturing, technology, life sciences, where capital expenditure is a huge part of the business, this immediately gives you cleaner, higher EBITDA figures.
And what do buyers, especially PV funds, look for?
High, clean, and predictable cash flow. Higher cash flow translates directly into a higher, easier to determine valuation, and that attracts premium buyers.
Okay, so that helps the operational side, but the real game changer for the owner-operator thinking about their personal balance sheet is the expansion of the Qualified Small Business Stock Exclusion, the QSBS.
This is maybe the most critical incentive in the OBBBA for the individual seller. BDO emphasizes that the QSBS expansion makes strategic investment consideration attractive to a much wider segment of the domestic middle market.
So break it down. What is QSBS?
QSBS allows owners of eligible small businesses to exclude a significant portion, often 100%, of the gain from the sale of their stock from federal income tax.
100%.
Provided they held the stock for at least 5 years.
So that's effectively a tax-free exit, which is the ultimate goal for many. What are the key eligibility thresholds that changed under the OBBBA?
Crucially, the eligible company threshold was raised. To qualify, the company now must have aggregate gross assets of no more than $75 million at the time the stock is issued.
$75 million, that's a key number.
It's a key number for the upper end of the domestic middle market. Previously, a lot of firms flirting with $50 million in assets would worry about exceeding the old threshold. This expansion just widens the door for more established domestic companies to use this powerful exclusion.
How does this specifically impact the buyer's thinking? I mean, why should a PE fund care if my personal exit is tax-free?
Well, the tax benefit goes to you, the seller, but it simplifies the deal structure, and it potentially allows the buyer to close that valuation gap without increasing their cash outlay. A seller who knows their $15 million gain is tax-free is naturally more flexible on the purchase price.
It becomes a huge negotiation tool.
A massive one. And furthermore, the OBBBA created new incentives for shorter holding periods.
Right, let's detail those. What if the owner has only held the stock for, say, 3 or 4 years?
That's right. While the best outcome is still that 5-year hold for the maximum exclusion, the OBBBA introduced partial exclusions for QSBS held for 3 or 4 years.
So it provides a safety net.
A safety net if a lucrative, rapid exit opportunity comes up earlier than you planned. For an owner looking to sell in 2026, working with your tax advisor right now to make sure every element of your stock structure is compliant with these QSBS rules is absolutely non-negotiable.
It's also vital to acknowledge what didn't happen in the OBBBA, isn't it? Because legislative stability is often just as important as favorable new rates.
Absolutely. The stability from what was excluded is crucial for buyer confidence. BDO points out two major adverse changes that were avoided. First, no changes to the tax treatment of carried interest.
And that's the mechanism PE partners use to earn a portion of the fund's profits, if that had changed.
It would have fundamentally altered the profitability model for private equity. It would have massively impacted their investment appetite and potentially slammed the brakes on this entire financial buyer market we've been talking about.
And the second thing it dodged.
The second was the introduction of the proposed Internal Revenue Code, Section 899.
That was often called the revenge tax.
Correct. And that provision would have really complicated transactions involving foreign-owned corporations and global tax rules. By avoiding those two major adverse changes, the OBBBA provided greater predictability and stability for both domestic and international buyers. And stability allows capital to flow freely, which is exactly what the middle market needs right now.
We started by talking about how AI drove that mega deal environment. So let's connect those tectonic shifts back to the immediate, actionable exit opportunities for specialized smaller firms. How does that $1.6 trillion in tech value create demand for services provided by, a Main Street business?
This is where we trace the ripple effect. AI drives demand for foundational assets. Data centers, microchips, AI-native software. PwC reported that technology led all sectors in October 2025 with over $109 billion in deals.
But a data center is just an empty box without massive reliable power.
Precisely. So the demand for AI infrastructure instantly becomes a demand for specialized power infrastructure.
Okay, I see.
EY observed that M&A activity in power and utilities, or P&U, is now fundamentally revolving around utility-scale consolidation, AI-driven power infrastructure, and energy transition assets. Financial investors are targeting the critical power assets needed for these data centers.
And that translates directly to M&A for smaller, specialized companies.
Directly. Think about the mid-sized electrical engineering firm that specializes in high-voltage infrastructure, or the regional utility-scale solar developer with shovel-ready projects.
They aren't buying the AI code, they're buying the energy backbone that's required to run the AI.
Exactly. These smaller companies are being acquired as bolt-ons to fill these niche roles in the infrastructure expansion. We're also seeing horizontal integration in the utility sector, where big firms merge to expand their reach, which naturally creates a need for smaller firms to fill specific technical or geographic gaps.
Okay, let's look at another big sector. Life sciences and healthcare. Activity there is always robust, but it can seem pretty opaque to a small operator.
Well, the activity is anchored by big pharma, consolidating in high-growth areas like obesity and genetic medicines. And you have PE buying scaled, cash-generative healthcare assets. That's what EY reports.
It sounds distant, but you're saying the implication for Main Street healthcare is immense.
It is. So what's the implication for, say, a regional network of specialty orthopedic clinics or a specialized medical billing service?
Right. What is it?
BDO notes that significant opportunities exist for transformation through service consolidation and technology adoption in healthcare. These specialty clinics, billing services, or regional health networks might be small individually, but they are incredibly attractive targets for PE firms looking to build a large, efficient platform.
The strategy is horizontal integration again.
Yes. Acquire a cluster of 8 to 10 smaller firms, standardize the technology, implement central billing, cut all the duplication, and achieve massive scale.
And once again, that depends heavily on that operating partner model we talked about earlier.
It absolutely does. When they buy 10 small, owner-operated orthopedic practices, they're buying 10 sets of different administrative practices, maybe 10 different technology platforms. The value is created by the operating partner who comes in, standardizes the tech stack to one high-efficiency model, and institutionalizes the back office. The value of that resulting platform far exceeds the sum of the individual acquisition prices.
And beyond these sector-specific niches, EY noted a general push toward horizontal integration in mature sectors, like banking and tech. What does that tell the typical Main Street business owner who might be thinking of selling?
It confirms that scale and efficiency are paramount. When two large firms merge to expand their geographic reach and reduce duplication, they inevitably create capability gaps.
A hole in their new combined company.
Exactly. They might find their new entity is fantastic in the Northeast, but has a gaping hole in a specialized capability in the Southwest. So if a small owner-operated tech consulting firm already dominates that specific region or niche, they instantly become a high-value, easy-to-integrate bolt-on acquisition for the new giant. They're buying surgical precision, not massive scale.
This confluence of trends suggests that if the window is open, an owner really needs to be ready to act fast, especially given the political environment we touched on.
That's the point PwC makes about government intervention. It's creating a need for speed. The current administration is taking a more activist, interventionist stance in strategic sectors like steel and microchips, sometimes even taking shares in companies. It helps.
This isn't just theoretical.
No. PwC suggests that companies that recognize trends early and act quickly face less regulatory risk than those who follow the crowd. For a small business, timeliness in securing a deal is crucial when that strategic fit is clear and the conditions are favorable. If you wait until everyone else piles in, you could attract unwanted regulatory scrutiny to your transaction, and that could delay or even derail the whole deal. So if we synthesize all the key takeaways for you, the middle market owner who's contemplating a 2026 exit, the picture is complex, but it's increasingly favorable. The fundamental market drivers that record PE dry powder, stronger corporate balance sheets, easing financing costs, they all remain firmly in place.
So the foundation is solid.
The foundation is solid. The market is set to build on the gains of 2025, especially now that major policy stability has been secured with the OBBBA.
Okay, so if the market environment is stabilizing, what stands out as the single most relevant signal for an owner-operator to act on right now?
Two signals are absolutely critical. First is that structural shift in private equity. That dip in their share of mega deals in October indicates they're moving down market. Competition for quality smaller assets is about to pick up significantly, which means you could find multiple motivated buyers. You could. And second, the QSBS expansion in the OBBBA. By raising that asset threshold and creating partial exclusions, it provides a huge, tangible tax benefit. This fundamentally makes your company a significantly more attractive target to investors who use sophisticated tax planning. The door for mid-market exits is opening wider than it has been in years.
So what does this all mean? The challenge for small, owner-operated businesses looking for a favorable exit in 2026 isn't just about timing the market. It's about being ready to execute when that buyer calls.
Exactly.
Many Main Street businesses, by their very nature, and often by design, they lack the clean financials, the documented operational procedures, and the institutional depth that a sophisticated corporate or financial buyer wants to see.
And to maximize your valuation, to capture that premium, you have to use this current window of stability to demonstrate clear, transferable value. That means immediately moving beyond tax-optimized accounting and getting your books audit ready for a buyer.
It means getting the SOPs out of your head and onto paper.
Yes. Institutionalizing those procedures so the business can run flawlessly without you day to day. And critically, it means clearly mapping out how your business can unlock the AI opportunity, even if it's just through new operational efficiencies, to attract those PE sponsors who are bringing in operating partners specifically to execute that cleanup and create rapid scale.
And here's the final provocative thought we want to leave you with. The current robust market activity for large deals at incredible $1.6 trillion in value, it depends heavily on stable trade policy and continued moderate GDP growth.
It's a delicate balance.
It is. For small businesses, your opportunity window may be shorter than you realize if global tensions escalate. If U.S.-China relations or other geopolitical events trigger renewed tariff volatility or supply chain chaos, the market's focus will instantly snap back to caution.
They'll use that dry powder defensively, not offensively.
Exactly. Therefore, the strategic urgency isn't about if you'll sell. It's about why you need a definitive strategic roadmap now to maximize your value and secure your deal before global uncertainty potentially closes this incredibly favorable exit window once again.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.